Okay, good afternoon. Thank you for being here and showing an interest in faculty research. This is very gratifying to the faculty that the students actually are interested in our research because it's actually research that drives this institution. It's ideas, I hope you've understood from your classes, it's a place of ideas. And it's this research that comes into your classrooms, maybe with some delay, in a few years. That's where the faculty actually burn on the long end, is on their research, so they can bring it into the classroom. Okay, I'm going to talk about a very, very different topic. For those of you who are a bit interested in value investing, this will be up your alley. I'm going to talk about the accounting for the value trap. You know, some very common labels in investing are value versus growth investing. It's everywhere. In fact, there's Morningstar styles of value versus growth investing. They can mean many different things. One very basic approach is simply referring to trading on certain multiples. Earnings to price, book to price, maybe sales to price, maybe cash flows to price. Where typically the main ones are being earnings to price and book to price. Typically people refer to, if you buy a stock with a high earnings to price ratio or high book to prices, you're buying value. And if you buy one with a low book to price or a low earnings to price, or let's say a high price to book or a high PE, it's called growth. These are labels that are put on here. They're quite mysterious labels. What's behind them, okay? And that's really the purpose of the discussion here. What's behind them? What are you buying when you're buying stocks under this type of discipline? Now, it's well known that if you buy high multiples, high earnings to price and high book to price, or low multiples, inverting it, that you tend to, on average, earn higher returns. Okay? That's called the value growth spread. But it's also known that if you trade in that position, you can get hit. Just ask those who were in this position in 2008. And I've actually been in that position for a long time. It's only really the last 12 months that value positions are really shown to be paying off. Okay? It has been not a very good trip under this style. There's a value trap, and so that's the title of the presentation. Let's understand the value trap. Let's understand what you're taking on in terms of risk when you get into this position. As I say, these are just labels. We have a very bad practice in this finance business of putting labels on things, probably for our marketing, okay, as investment advisors, putting labels on things which is not very transparent. What's value and what's growth? Well, I hope to give some clarity to that. Now, Columbia here, of course, we're the School of Value Investing, and value investing works under certain types of certain principles. And two of those principles are on the board here. One is, ignore information at your peril. If you're just using two pieces of information, earnings and book value, for example, it's only two pieces of information. Now, no. Perhaps they're important pieces of information because earnings is the bottom line number in the income statement and book value of equity is the bottom line number of the balance sheet. But using only two pieces of information, you're in danger of trading with someone who's used more information. Someone who's done their homework, okay? And the other mantra of value investing, very strong amongst value investors, is beware of buying growth, because growth is risky. Growth can be competed away, okay? Beware, it's risky. And this idea is going to come very much to the fore in my presentation here. Just to fill you in on the historical returns, what I've done here is I've formed from from years from 1963 to 2012, each year I rank firms on the basis of their earnings to price ratio, or their PE ratio, and form them into 5 portfolios. These ones here have negative earnings, okay, and all the positives are in these portfolios here, in portfolios 2 to 5. You can see that yes, ranking on earnings to price, the returns are higher for high earnings to price than the low earnings to price, although there's a little bit of a higher return on these negative ones here. It seems to historically work on average, but there's a trap. Now, excuse me. Now take those same portfolios, the earnings to price portfolios, across the top here. That's the same portfolio with the same annual returns, okay? And within each of those, rank on book to price. This is book to price going down the columns here. And so you can see that for a given earnings to price, the higher the book to price, you get higher returns, okay? And you see the spread from here, 2.2, to here, high and high, 28.8. That's a big spread. Okay? Very tempting. Very tempting. Of course, we've got to be careful here. If you take on more risk, you have to have higher returns to reward you. Okay? So these returns here may be actually because we get higher return. That's the question we're investigating here. Okay, now I have an admission to make. I'm an accountant. Not many people admit to that. Okay? I'm also a value investor. And I actually am a very enthusiastic accountant. Even rarer. Because I actually think understanding accounting and understanding the fundamentals of business through the accounting really pays off in value investing, okay? I'm just going to give you one demonstration here today. And as an accountant, I say, well, listen, hold it. Earnings and book values are accounting numbers. So a given price, in fact, they're just accounting phenomena. It depends upon how you measure or you account for earnings and book value. Is there anything about the accounting for earnings and book value that tells me what I'm getting into, and particularly the risk I'm taking on in taking these positions? Let's think about earnings to price. Let's first think about a bond. Now, do you remember your core accounting course? Do you remember the accounting for the interest on a bond? Not a big show of hands. It's called the effective interest method. That is, we measure the earnings on a bond, irrespective of the coupon. It's exactly the same if you have a coupon or you have a zero coupon bond. We call it the effective interest method, effective interest method, and it says set the earnings such that the expected earnings are equal to the bond yield. Okay? We know the bond yield is related to the risk. So the earnings to price on a bond is actually related to the risk. In fact, the earnings to price equals the bond yield, and the bond yield is lower on a AAA bond than on a BBB bond. Okay? That's how the accountants capture risk. And so you might think, well, if I go back to here, well, I might expect earnings to price to pick up some of that risk. Okay? Because it's a yield. However, we're looking at stocks here, and stocks, unlike bonds, can give you growth. Bonds can't have growth. You just get the maturity value. The stocks have growth. And so we understand that the EP ratio, or the PE ratio, also embeds growth. And we typically think when your firm has a high PE ratio, that's a stock that's going to have a lot of growth, okay? Earnings are low now, they're going to be higher in the future. It has a high PE ratio. So a PE ratio indicates growth. The book to price. How does book to price relate to risk? Well, let's think about the accounting. Let's suppose you invest in a money market fund which simply holds US government securities, okay? They are supposedly risk-free. Though we are getting a bit worried about that. What's the book to price? It's always 1, right? Because the book value, called the net asset, the net asset value, is equal to the price of the bond. It's mark-to-market accounting. You buy a risky equity hedge fund. What's the book to price? Well, actually, it's also 1, because it's mark-to-market accounting. You just add up the market value of the stocks in the fund. That's the NAV, okay? It's also 1. So book to price cannot indicate the risk here, okay? However, typically for a non-investment fund, we use a different sort of accounting, sometimes referred to as historical cost accounting, where actually the book value is not equal to the price. We just record the assets, and indeed some of the assets, just at historical cost, and we don't add to the book value until later, okay? So here's the one we're looking at, because this is particularly, this sort of accounting is the accounting we're going to be interested in when we're looking for the pricing of manufacturing, retail firms, financial firms, and so on. Okay, now let's look at the theory of what determines an EP ratio. I'm going to use a very simple model here. It's a model that actually only works strictly if you've got full payout. That is, the dividends are equal to the earnings. But I can give you a more complicated model for all payouts just to complicate things, and I want to do something simple so you see it, okay? Price equals earnings, forward earnings, capitalized at required return minus growth. This is a legitimate pricing model. And so earnings to price is actually the required return, which of course is based on the risk you're taking on, minus the growth. Now, we sometimes say, if growth is higher, you expect a lower EP ratio or a higher PE ratio, okay? Growth gives you a higher PE ratio. But that, of course, is holding the R constant. You can imagine that if you have increased growth and growth is risky, you may not get the growth, you'll have a higher R. Keep that in mind when people talk about a PE ratio. It doesn't reflect growth, okay, necessarily. It reflects growth and the risk of the growth. And that's going to be it. So for a given earnings to price or a PE ratio, am I buying a firm with a high R and a high G, or a low R and a low G? What risk am I taking on, okay? That's the question you've got to ask when you're buying a given PE ratio. Here's Apple, beginning of the year, January 1. PE of 11.5, EP the reciprocal 8.7, R minus G. What am I buying here? Well, it could be the EP is a 12% required return with an expectation of 3.3% growth rate, okay? It could be an 8.7% required return with 0 growth, or it could be, as some people speculate, it's actually low risk, but actually it's going to deliver you negative growth. Apple's best days are over, okay? So clearly there's some sorting out to do here when you buy a PE ratio. Am I buying a lot of growth, a lot of risk, or am I buying no growth and very low risk? And remember, growth is always risky. It may not pay off. Okay, so let's now add, let's now add to that earnings to price, let's add our book to price. Here again is just my spread of returns that we had before, okay? Now what I'm going to do now is go through and set up an accounting analysis which actually explains what's going on in each of these cells, this 5 by 5, okay? What are you buying in terms of fundamentals here versus here, and so on and so forth. Okay, now let me give the expression for the book to price. This is not very difficult to follow because I think grade 5, you could probably do this in grade 5, okay? The earnings to price, the book to price is just the earnings to price multiplied by the book value over earnings. The earnings cancel, at least they did when I went to school, okay? And that, of course, book value over earnings, the forward earnings, is just simply the book rate of return. And I'm expressing the earnings to price according to the model as R minus G. And now I have three statements here, okay? I want to understand what I'm buying when I'm buying a high book to price, which is what we're supposed to buy because that's supposed to give us returns, okay? And we're worried where that's a risk. Okay, for a given earnings to price, that is holding this constant, it must be that book to price, for book to price, in ranking those book to price down those columns for given earnings to price, it's an inverse ranking on the book rate of return, okay? We can see that very quickly here. So for holding this constant, the lower this, the higher this must be, okay? Secondly, if a higher book to price must be associated with G, growth, if this ROE is negatively associated with the growth, okay? So holding this constant, lower this, the higher this, then the higher must be the book to price. Third statement, a higher book to price must be higher if, must indicate a higher required return, risk and a higher return, okay, if a higher growth is associated with higher risk, because you've got R minus G constant here, okay? Let's examine those statements. The first one is just mathematical. So this is just purely a demonstration that has to be. So I have that same matrix of portfolios, and I understand for a given to earnings to price that a high book to price is low ROE. These are ROEs in the cells, average ROEs for these portfolios, okay? So you see they're much higher here than here. They're much higher here than here. There is a little bit of something going on here which actually can be explained, but I won't do it, okay? So that's very clear. So when I'm buying a high book to price, I'm buying a firm with a low ROE. Now, the second thing is, the question is, remember back here, I've got these if, these are conditional statements, these if are in red, okay? And so does the conditional statement hold? Well, now I'm going to look at, for a given to earnings to price, I'm going to ask is, what's the future growth that I get, okay? So I go 2 years ahead, I can go 3 years ahead and more to show you this, but actually these low ROE portfolios or the high book to price for the growth I get 2 years ahead in terms of earnings growth is higher, okay? So for a given earnings to price, the higher the book to price, the lower the ROE, you're buying more growth. You're buying more growth. But point 3 is it the fact that this growth that you're buying is risky? Is it risky? Because then it will require higher R. Well, here's first of all, the standard deviation of the growth rates 2 year ahead, and you see as you go down here, that standard deviation or that variance increases, okay? Yes, you get a higher expected growth in earnings, and you like growth in earnings, okay? That's going to give you value when the earnings come down the pipe, but there's more risk that you won't get it. Very instructive is now if I look at the interdecile range of the earnings growth that you actually get 2 years ahead, the interdecile range being the 0.9 percentile minus the 0.1 percentile, so it isolates the extremes, okay? this debt tolerance increases as you go down these columns here. That is, down here, you're more likely to end up in the right-hand extreme, the right-hand tail, or the left-hand tail. If things work out well, you'll be in the right-hand tail. But if things don't work out, you will get pounded in the left-hand tail. That's risk. Call it fundamental risk. I can give you, we tend to think about risk as being systematic risk, okay? What happens to your earnings as you get shocked to market-wide earnings? Here's I report what we refer to as fundamental betas. You know betas in terms of returns. Here's the fundamental betas. How sensitive is the returns, the earnings on a portfolio to shocks to earnings market-wide? If I get a recession and earnings generally go down, which portfolios get hit more, okay? And you see that these betas, again, increasing down here. These are much more subject to shocks. And I can show you that actually this is up market betas and down market betas. Here, up markets, I do very well down here, okay? Putting me in that right-hand tail. But in down markets, I do a lot worse. There's the risk, okay? So the three conditions I put up for book to price to pick up risk are actually satisfied in the data. If that's all you want, you can leave now, except this admitted accountant has an explanation for this. Okay, excuse me. Why is a low ROE positively associated with future growth, and why is that growth risky? It's all because of the accounting. Here is the main accounting principle that drives accrual accounting or historical cost accrual accounting. We do not recognize, the accountant will not recognize earnings until the uncertainty has been resolved. The price may indicate we expect a lot of customers in the future, okay? Think of Amazon, very high price, expect a lot of customers in the future, but the accounting may tell you, hey, we're not going to recognize that yet until you actually get the customers. And even then, we're going to discount the receivable for the probability you're not going to get the cash, okay? In finance terms, for your finance students, we don't recognize earnings until we have a zero beta asset, an asset which is pretty much risk-free. That's how accounting works. It does it in two ways. First of all, yes, as I said, we don't recognize revenues, that top line, until we get a customer. And if you recognize revenues before you get a customer, the SEC's on you, and you go to jail, you slime bag, okay? That's very much there, okay? The second thing is, and this is very important, understand the accounting works. When you make risky investments as a firm, we're not going to allow you to put that on the balance sheet. You've got inventory, you can put it on the balance sheet. You've got a product. If you've got a factory to make the product, you can put it on the balance sheet, but we're going to impair it if there's any doubt about that, okay? But if you're doing R&D to produce a product, and you don't have a product yet, you can't put it on the balance sheet. What do you do with it? You've got to expense it immediately in the income statement. If you do advertising to build a brand, promotion, startup costs, employee training costs, developing supply chains, distribution chains, the accounting is very conservative. You can't put these assets on the balance sheet because we don't want water on the balance sheet, okay? That's actually another mantra of value investors. Benjamin Graham would say, you accountants don't put water on the balance sheet, because he had the experience, the previous president, of actually the accountants writing up assets in the 1920s, and all that water on the balance sheet evaporated on that day in October. And actually, if you go to the typical SG&A, selling general administrative expenses in the income statement, over 50% of the expenses are investments that are expense. Now, what's that going to do? Well, both those things, deferring income to the future because you haven't got customers yet, and expensing, it's going to reduce your earnings and it's going to reduce the numerator of your ROE, right? And very often a loss company, look at it closely, is not making losses. It's because they're investing and they're reporting negative profits because those investments are getting hit onto the income statement. The accountants are doing it because we think this investment is risky. We're not going to put it on the balance sheet. Okay? Now, however, if you expense earnings now, you've got to have higher earnings in the future. Earnings coming from the assets. If it's successful. And that's earnings growth. Lower earnings now, higher earnings in the future. That's earnings growth. In fact, because you don't put the assets on the balance sheet, you're going to have no amortization or depreciation against those future earnings. You're going to have more earnings in the future. That's growth. But the accountant says it's risky growth. Now, if, notice the red, if it's successful, what's going to happen to your ROE? Well, the earnings are going to come through the income statement because now you've got the customers. The balance sheet, there's nothing on the balance sheet. Okay? All the investments have been expensed. You're going to have a very high ROE. And so what do we get? As a result of the accounting, you've got the accounting inducing growth. You get low ROEs indicating risk, and a high ROE that's successful, indicating that you've been successful, and therefore lower risk and a lower required return. And so that's why it's ROE that is sorting out the growth, the riskiness of the growth, and indeed the returns that we saw in those diagrams. I'll finish up with a couple of examples. Amazon. Now, a lot of my value investing friends don't like Amazon. They think it's too expensive. And some of them are shorting Amazon. I actually agree with them, but I'm not going to short because shorting is risky. They say, look at Amazon. Up to just the last 15, 18 months, its net doesn't make profits. It always reports losses, okay, from its e-commerce operation. And it only has profits now because of their cloud services business is bringing profits into the firm, okay? You look at their basic e-commerce business, it's not profitable, and a value investor says, I don't buy unprofitable businesses, okay? But they are not quite correct. Because if you go to their income statement, you'll see a line saying technology platform development. Okay? A huge percentage of sales. What's he doing every year? Something new. Okay? It's grocery delivery, it's video streaming, it's making films, it's getting drones, developing software for drones, and endlessly. Okay? What happens to that investment? It gets expensed immediately. And the low ROEs, return on equity, are due to that expensing. Amazon is not an unprofitable company. Amazon is a company which is potentially very profitable. Because if, in fact, all that investment pays off, you'll have huge earnings, nothing on the balance sheet. It's all been expensed. You'll have very high ROE, okay? But the if is in red. It may not be profitable. That's how you read it. Oh, what happened here? We've got to get back into this. I'm sorry about that, very clumsy. Your professors are supposed to learn how to handle these things. You know, these are the worst instrument in this school. They're very bad. This school doesn't give you good. Okay, Amazon. I can give you Twitter, exactly the same. Look at Twitter. It's making losses, okay? Has made a profit. Go to the income statement, you'll find 85% of the expenses are R&D and promotion. It could be very profitable if the customers come. The customers are not coming, okay, actually. Very doubtful. Coca-Cola, now here's a company with a very high rate of return, okay? It looks very profitable. Why? Because it has a brand. Its earnings from the brand are coming from the income statement, but the brand is not on the balance sheet. Very high book return. The beta is 0.4. Okay? So there's the connection of the accounting, the book rate of return to risk. I just don't give you the documentation that actually these high book-to-price firms are low ROE firms, but I give you a document. Actually, that maps into growth, and it maps into risky growth. And why is it? It's because of the accounting. That's how the accounting handles it. And that's a lesson to us when we think about profitability, okay? Profitability is accounting profitability. It's not real profitability. And the accounting accounts expensing investment, you get a very different picture. Final slide. A curveball, or if you play cricket, a googly. My game. Value versus growth. It's said that a high book to price is value, a low book to price is growth. No, it's the other way around. When you look at it, particularly in conjunction with earnings to price, okay? These labels have actually been misapplied. They've been misapplied. For a given earnings to price, book to price is positively related to growth. It's related to the risk that you're not going to get the growth. There's some references for you if you want to dig deeper. But I just want to take you back to the returns here just to finish off. There's a big spread between here and here. Okay. Now, by the way, I'm not saying necessarily there's not abnormal returns there. That actually, this is actually a good trading strategy. Okay, and those returns look really good. All I'm saying is, if you troll this and pretend you're not taking on risk, just beware. Okay, you are taking on risk. Now, look at the spread here as you come down here and across here. That's a big spread. And the difference between 2.2 and 28.8, that is a big number. Okay. And you might ask, how could so much money be left on the table? Well, part of it's due to risk. And here's my reading for what's going on here. It started in 63 through to 2012, 2013. It's for a particular country called the United States of America. That was a period where buying risky growth really paid off. Okay? In terms of national experiences, you ended up well in the right-hand tail. Okay? It was, after all, the American century. So these returns, you've got to be careful of seeing as, oh, this is a free lunch down here. Okay, just like the lunch we had today. It's a free lunch. No, it's from a period when you're in an economy that really paid off. Okay? You bet on growth. If it had gone the other way, it would have been very different. Okay? That's how to interpret those returns. And in my mind, when someone advertises returns to you on their fund, they use the returns that they had a good period and they bet on growth. And the growth paid off. Now, if you bought Japanese stocks in the mid-19th century, if you bought German stocks, if you bought Chinese stocks, it would have looked very different. Okay? We haven't had the revolutions and all the rest of it. Won most of the wars. Okay? It was the American century. You bet on growth and it paid off. So, thank you for your attention.